Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. And joining me today are the crack members of the ETF.com editorial team, senior ETF analyst Sumeet Roy, senior content editor Kent Tooney, financial reporter DJ Shaw, and contributing editor Ron Day. Welcome. It's been a hectic week since we last gathered. We've seen the first quarter of 2025 come to a close. We've seen interesting ETF launches and, of course, the announcement of sweeping new global tariffs. There's a lot to cover, so let's jump right in. Sumeet, this week you wrote about ETF flows for March, a few days ago, actually. And the data showed IVV, the iShares Core S&P 500 ETF, leading net gainers for the month. And Ron, you wrote a story yesterday that IVV is now positioned to take the title of world's largest ETF from Vanguard's VOO, which just toppled State Street's SPY not long ago. So my question to you both, what's behind all this activity and what does it mean for ETF investors? Sumeet, let's start with you.
Yeah. So, like you said, Paul, it was a good month for ETF flows. March was, we saw nearly $100 billion of inflows, $96 billion or so. And that brought the year-to-date inflows number up to 293 billion. So I think that's significant because obviously March was a month of turmoil in the markets. We all know that the S&P 500 briefly fell into correction territory during March. Then I think April 1st, we rebounded a little bit, but now we're back in correction territory. But I think the takeaway is that despite this volatility and all these concerns about trade wars, investors continue to plow money into ETFs. Obviously, this is a long-term trend, but it also signals that investors aren't that concerned, right? There is an underlying bid, I should mention, right? Even when markets go down, we tend to see long-term investors put money to work in ETFs over time. But when things get really bad, we do see occasionally redemptions from ETFs and outflows from ETFs. We haven't seen that yet. Overall, it's been steady as she goes in terms of ETF flows. And that is what we saw in March. And like you said, IVV was at the top of the list, $22 billion of inflows. But VOO was there as well. It was number two with $6 billion of inflows. Those aren't necessarily that surprising, not even that interesting, right? We see those at the top of the list all the time. What I think is more interesting is this continued demand for ultra short-term bond ETFs. We saw SGov, for instance, pick up another $3.7 billion, BIL, another T-bill ETF, $2.9 billion. So that's interesting to me because people seem to be looking for safe havens. They're not pulling money out of stocks necessarily, but they're parking their money in cash-like instruments. That's what these ETFs are. And they're also putting money, and we'll probably talk about this a little more deeply later, which is gold. They're putting money into gold. GLD had $2.9 billion of inflows in March. So it's a combination of investors aren't panicking, but they are looking for safe havens. I think that is the takeaway from what we saw in those March flows figures.
And Ron, what's the jostling behind all of this? What does it mean in terms of who's coming out on top? Number one, there
Yeah,
seems to be jockeying for position here for the world's biggest.
yeah. Well, I mean, on the surface, we can look at the numbers. That's what we have access to. I don't know what's going on behind the scenes with, market makers and, what's going on at institutions, but, on the surface, we know SPY is the most expensive of the three biggest S&P 500 ETFs. So its fee is three times that of VOO and IVV. And as Ken Tooney had mentioned to me the other day, SPY is often used by institutional investors and active traders because it's so liquid. Um, so I don't know. Maybe this is just retail investors are kind of grabbing the mantle right now and to take advantage of the lower fees. SPY has this legacy, right? It was the first ETF, monster liquidity, and again, it had the whole SPDR name. And, there's just so much marketing that goes along, just kind of intrinsic when you're that big. But, they're going up against BlackRock and Vanguard, which are also, they're both larger organizations in terms of AUM. So,
So how would you
again,
differentiate IVV from SPY and VOO? Obviously, all things being equal in terms of what they cover, SPY and VOO, it comes down to maybe expense, as you're indicating that one is cheaper than the other. So how does IVV play into that?
well, I can tell you this about SPY. When SPY drops, it drops a little bit more than the other ones. Not much, but I mean, when we're talking about an industry where you're shaving millions of, or fractions of pennies, SPY is a little more expensive, and it's a unit investment trust, and it's required to hold dividends and cash until distribution. So that could have some effect on it. Now, DJ Shaw wrote about this a few weeks ago. It had some good insight, and also Kent being our resident CFP might be the guy who looks down at these things and says, well, I'm going to pick VOO for my clients over SPY because of, whatever. So,
All right, Kent, you've been brought into the conversation. Where do you stand on that?
I can add, yeah, Ron's right. I would just add a little bit more to that and say uh, IVV is probably, we don't have demographic information. I don't know if anyone shares that or if any of the fund companies do that, but IVV, I would say, is more of an advisor bought fund than VOO. And with my own anecdotal evidence, years ago, probably 15 years or so ago, I used Fidelity as a platform to trade. Fidelity and Vanguard are basically enemies behind the scenes, right? Fidelity charged fees to buy Vanguard funds. They also, at the time, allowed trading of iShares at no transaction fees whatsoever, commission free. So I was loading up my clients' portfolios with IVV. So I think that IVV is a little bit more of an advisor fund, and I think that VOO is much more a retail fund. And that's what I've seen is that when we have outflows or selling of any kind, there's usually more selling from VOO in a down market. That's why I think IVV could pass VOO today as we speak, which is Thursday. You're hearing this on Friday, but everything's down on tariffs. I wouldn't be surprised if VOO loses more than IVV today. I'll be buying IVV myself.
Interesting, because that was that I wanted to end this part of the conversation on that note is what do we anticipate who's going to be on top when the smoke clears? Is it going to be IVV, SPY, or VOO? SPY just keeps sinking, it looks like, and the battle seems to be between IVV and VOO. Remains to be seen. But Kent, that brings us to something else. Ron mentioned quite accurately that you are a CFP, and you do consult with clients, and we did, and Sumit also did mention that we would be talking about gold, and we should be. So I have a question for you. There's a new kind of gold rush in the 21st century. And it looks like these days you don't need a pick and shovel to get rich, looking for the shiny yellow metal. So Kent, you've written several articles this month about gold and gold miner ETFs. But you also wrote this week that gold may now be a contrarian play. So what's behind this investment thesis, and how are you integrating that view into your practice as a CFP?
Great questions. Well, I'll go back a little bit in time for a lot of my risk averse clients. Gold can be a great diversification, and I was already buying into gold a couple of years ago, and so it's been on a great run over the last couple of years, and especially this year. So, I would just say classic rebalancing can be a good idea, and that's what I'm recommending to clients now. And I've already started to do that over the last couple of weeks, meaning that we're not timing the market. We don't just sell out of gold because it's at a high point, or buy stocks because they're at their low point. But it might be a good time to trim off some of the winnings in gold, like say GLD ETF or GLDM for the lower expense ratio version of that, and maybe buying a little bit into stocks, especially for some of my younger clients long term. Today is a great day, or Thursday, this week. Another thing that I noted in that article was really about flows. Samit mentioned 2.9 billion in flows last month for GLD, and it was 3.8 billion in February. And so those 2 months combined, we haven't seen those consecutive months of inflows for GLD since COVID. And the only month that I could find that was higher than that or that combined was February of 2009, which was the end of the Great Recession, the financial crisis. So that's why this looks like it could be a contrarian play, or at least a time to rebalance.
Also, we have to take into consideration that there are other precious metals that have been doing pretty well. We've seen the silver ETF, SIL, and the copper ETF, CPER, doing quite well. Copper, especially, is doing pretty well. So, with gold, precious metals, uncertainty, are we seeing the flight to safety? And where are ETFs offering that kind of comfort level to investors of all stripes, whether it's institutional investors or retail investors? What do you think, Samit?
Oh, absolutely. It's like I mentioned when we were talking about March inflows, we're seeing it in gold. We're also seeing it in those ultra short-term bond ETFs, right? Like SGOV, BIL. These are safe havens. But while SGov and BIL, you're definitely not going to lose money on those unless the US federal government defaults or something like that. Those are literally the risk-free instrument, treasury bills. On the
Don't
other hand,
forget, Warren Buffett owns Escov, and everybody's saying, "Oh, I should have followed Buffett into cash at the beginning of
he's
the
sitting on
year."
what, $300 billion of cash. Great timing on his part. Well, I mean, he's been piling that up for years now, but it's looking pretty good right now. We'll see if he deploys that eventually. But
You
yeah,
can't you can't
T-bills,
take it with you, right?
no, you can't, right? So yeah, T-bills, great safe haven if you're worried about the markets and psychologically it feels better to have some cash there. But gold is a different animal, right? It's rallying on all the volatility that we're seeing. It's up something like 18, 19% year to date. But like Kent has alluded to, we don't know how far that's going to run. We don't know when it's going to top out. And that's the risk of kind of at least piling into gold right now, thinking it's this safe haven, right? If you want to allocate to gold, think of it like a long-term asset and buy it over time. Don't try to chase it right here. That's a totally different strategy. That's more like a momentum strategy. It's working right now. You think it's going to continue to work. That's more of a momentum trading strategy. Long-term investors have to think about it differently. You want to allocate a portion of your portfolio to gold over the long term, maybe 1, 2, 3% of your portfolio. And if you do that, then over time, it can give you those portfolio diversification benefits, the lack of correlation to other assets, things like that. So two completely different types of safe havens, but we're seeing demand for both of them right now, gold and ultra short-term bond ETFs.
And I'd be remiss if I didn't bring up what has pretty much brought on all of this uncertainty and some of these movements. It'd be pretty easy to say that President Trump's tariff announcement on Wednesday and the weeks leading up to that announcement have roiled markets. So this economic strategy of his opens a world of possibilities for ETF investors in multiple regions as alternatives or hedges to a possible US recession. Now, we've written about the flow of US capital into international ETFs. And DJ, you wrote in this morning's Food for Thought about a report that focuses on emerging markets. So to kick off this discussion of tariffs and what tariffs mean for ETF investors, what are some of the funds or sectors funds that cover sectors that you see that will benefit or possibly suffer?
Yeah, this report was pretty thorough and interesting. It went through a lot of different sectors and it moved a few of them from a neutral rating to an overweight rating. One sector that was unchanged was gold. This remained in the overweight section. It remained unchanged as it was mostly seen as a hedge against market volatility. But a few of the other sectors that did move from neutral to overweight were emerging markets, excluding China Both of these were moved over because China's economy is set to grow by 5.2%. This is fueled by strong industrial production, stabilizing housing market, and its ongoing fiscal and monetary support. China's recovery has also been a boost to emerging markets. I want to mention a few ETFs. So for emerging markets, excluding China, one ETF that I found was EMXC, and then for China, MCHI. A few other sectors included financials. IYE is a good example, utilities, IDU, and communication services, XLC. So these were just a few of them that moved over, but one that moved to neutral were European government bonds and U.S. treasuries.
Interesting.
And this they moved to neutral after recent yield movements.
That I find that interesting also in that not only that you see some consolidation in government based ETFs, but also that you could start to see consolidation among emerging markets ETFs. So there's a report now that's out that's saying that this is making strange bedfellows, especially in Asia, with China taking the lead in building a coalition, a trade coalition with Japan and South Korea, who have been bickering over trade for a very long time. So we could see some really interesting and unexpected outcomes as a result of this. So I'll open this up to the panel. Where do tariffs and the prospect of tariffs as a weight on the U.S. economy and possibly the global economy, where does that fit in with the ETF investor, and what can they do to either profit from or protect themselves from what's coming?
Our social media person, Joy, she put in LinkedIn, Instagram, everywhere else.
That's Joy Shi. Those of you who are
right,
listening.
Joy Shi, yeah, she's awesome. But yeah, she reposted something I published a month ago, the best ETFs for stagflation. So you've got a combination, which is rare and potentially devastating to the markets, is a combination of inflation and a slowing economy, which tariffs can cause both inflation and a slowdown. So those ETFs, we went back and looked for March. If you equal weighted all 10 of them, you're up 2%. And if you bought the S&P 500, you're down about 5%. So and those ETFs, just a quick rundown, include, say, utilities like XLU, consumer staples like XLP. We mentioned ESGO, the ultra short-term bond ETF. There was a couple other ultra short-term bond ETFs in there. Of course, gold and silver, both of those were up like 8 or 9% last month. So there's ways to do it. Now, of course, none of this is a guarantee it'll continue, but if these conditions continue, then we could still see those ETFs outperform. ETFs for stagflation.
Yeah, I mean, Kent put it nicely as it relates to the US economy. Obviously, tons of open questions. No one knows whether these massive reciprocal tariffs, which actually aren't really reciprocal tariffs, but they're being called reciprocal tariffs. We don't know if they're going to be with us a week from now, a month from now. So that's all an open question. But I think what's an interesting question is what happens to the US economy? Yes, but what happens to the international economies as well, right? Because right now investors are kind of voting and they're suggesting that the US economy is going to be disproportionately hit. We're seeing the S&P 500, as we're talking, is down 7% year to date. But you look at most international stock ETFs and they're still higher. VXUS, Vanguard's big ex-US ETF, is up 5% year to date. Big gap between what we're seeing in that fund and S&P 500 funds. You're seeing Europe ETFs still up double digits on the year. So we're seeing those pull back, after these reciprocal tariffs were announced. We're seeing them pull back a little bit, but they're still up pretty notably on a year-to-date basis, which suggests that investors think that these international markets are going to perform better than the US markets. And I think that's interesting, right? For many, many years, we wondered, is the US just going to continue to dominate? Is it going to continue to outperform? are international stocks ever going to close that gap? And this year it's happening. So that's a very important thing to consider. Do you want to put international exposure in your portfolio? Because we don't know what's exactly going to happen with Trump's tariffs, but there could be long-lasting ramifications from what's going on today, and it could have meaningful impact on the performance of US ETFs versus international ETFs. And I think people have to think deeply about their portfolios and how much exposure they want to global markets. It's something people haven't had to thought about much over the past decade because the US just crushed everything. Now it's time to just actually think about it.
It's definitely something that we will be keeping an eye on as an editorial staff going forward, and not just for our fodder for our writing and reporting every day, but also for our readers who are relying on us for what's happening in ETFs and how it relates to markets and investing in general. Finally, I'd like to introduce a new segment to the podcast. I like to call it Flirt, Marry, or Kill. So I'm going to throw a ticker your way, and you tell me what you would prefer to do with it. All right. So first up is TLT. Ron, flirt, marry, or kill?
I'll go with flirt because, yeah, I'll go with flirt. It's kind of like an exotic thing.
I
We've
like
had
flirt
days
for
like
that one
that.
too, Ron. I like flirt for that.
Okay. Yeah.
So we got two
Because
flirt.
I kind of think of it like a recession hedge. It's kind of a tactical recession hedge. But if suddenly yields dropped and TLT went through the roof, I might lighten up my position on TLT. I wouldn't necessarily marry it, hold it through thick and thin, but it does make sense for the portfolio under certain contexts, in my view.
Kent, flirt, marry, or kill?
If flirt means holding it for a handful of months, then it would definitely be flirt for me. TLT. Yep.
All right. And DJ, flirt, marry, or
Yeah,
kill?
I think I might be a little bit too young for
Oof.
For marriage or
TLT.
what?
You think TLT is a bit of a cougar for me? I think I'm gonna have to go with
Good.
Phil.
Good answer. Good answer, DJ. Okay. All right. Next one up, TSLL. Samit, flirt, marry, or kill?
Oh my God. This one's between flirt and kill. Like, I'm not going to kill it because I know some people use it for their day trading and super aggressive trading. But personally, I would never do that. So between flirt and kill.
Kent?
I'm a contrarian, not all the time, but if you would ask me the question when the Tesla cars were on fire in the parking lot and all that kind of stuff, I would have flirted with. But at this point, I think I'd probably leave it alone. Yeah, little bit too risky for my taste.
And DJ?
Yeah, I'm gonna have to agree with Ken on that one.
All right. And last one. Here we go. IVV. DJ, flirt, marry, or kill?
IVV is one that I would say I'd have to marry. It's doing real good lately, at least, flows wise. It's been piquing my interest.
Love at first sight. Kent, IVV.
Definitely marry. Yeah, it's got the right combination of excitement, not too boring. Hold it for the long term.
Ron,
Put a ring on it.
put a ring on it. All right. And Samit.
Yeah, I mean, I would be shocked if anyone wanted to kill that one. So yeah, definitely Mary.
All right. So our results for today are we definitely would flirt with TLT. We definitely would put a ring on IVV and marry it. And as with anything related to Elon Musk, the relationship with TSLL is complicated. So we'll leave it at that. All right, then. It looks like our time is up. Thanks to all our listeners for streaming the Exchange Traded Fridays podcast. And please like, subscribe, or follow us wherever you get your podcasts, whether it's Apple Music, Spotify, or Google Play. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter. Our handle there is @ETFCOM. Thanks for listening, and see you all next week.